presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Welcome to Compak's Market Wrap Weekly Update here on YouTube. I'm your host today, Javaid Ansari, Executive Vice President at Compak Asset Management. Filling in for your longtime host, Mo Ansari. He'll be back with us next week, but just wanted to give you a little bit of insight into what happened last week in the markets, what we're expecting this week. It is a big week. We do have the Fed meeting here on Wednesday, so always these weeks are a little bit more seminal when it comes to the market environment, so we'll preview that and just see, kind of really set the table for the rest of the month. It's been so far a wonderful start to the year. Hopefully everyone has enjoyed the nice gains in their portfolios. But exactly where are we at in the cycle and where are things headed? We'll talk a little bit about that on the YouTube today. As always, if you'd like to get this communication on a weekly basis, please just go to compak.com/media and you can just put in your email there. That's all you got to do. And we will send you the latest update in terms of the YouTube update, which we update typically weekly. The podcast, which both myself and Mo have been hosting since late last year, where you get a more in-depth analysis in exactly what we're looking at in terms of the markets, what indicators we're looking at, and changes as we see in the markets on a weekly basis. Typically, that's posted to your favorite podcast channel every Monday evening. And then you'll also get the Compak Market Minute. And I think this is a really good piece of information for you to just really digest exactly what we've seen in the markets. You also get our chart of the week, which I think is very important to kind of understand what themes we're talking about. And we'll highlight that, of course, in the YouTube today. But that's a great piece to send to friends, family, if they want to get a little insight into the Compak communications and how we go about really educating not only our clients, but our listenership here on Market Wrap regarding the markets. So definitely go ahead and visit Compak at compak.com/media. You can just email us at invest@compak.com, or of course, give us a call at our longtime 800 number, 800-388-9700. So just jumping at the markets last week, we saw the S&P just kind of flat. I think that was a good development given the inflation data that we got, both CPI and PPI, coming a little bit hotter than expected. So typically that can be at least it was clearly in 2022, a big catalyst to the downside in terms of the stock market as we see interest rates jump. And we talked about in the Market Minute this week, we did see interest rates basically go, whenever we talk about interest rates, we talk about that 10-year Treasury. I'll show you that here in a second, but that did go from 4% to 4.35% as of today. So a pretty tangible move back above the 200-day moving average on the 10-year U.S. Treasury. And we feel like, that could start to be a little bit dicey for the market here headed into later this month, and particularly with what the press conference from the Federal Reserve looks like here in 2 days on Wednesday. Because if we start to see those interest rates go higher, everything looks good on earnings, at least so far, but the valuations continue to get more and more expensive the higher those interest rates move. And so anywhere we kind of think if we get above 4.4, 4.5%, that could be a little bit of the market saying, we may need to take a breather on these valuations of the stock market at the moment, and that could be a catalyst for a correction. But looking at the rest of the markets, you can see small cap did very poorly last week, down 2%. That's very typical. I think you're going to continue to see that as long as interest rates are kind of trending either sideways to higher. I think you're going to start to see some tangible outperformance in the Russell 2000 once interest rates come down. But I don't think we're quite there yet. Seems like this last mile of inflation is a little bit sticky. I'm going to dive into that a little bit more. Mohamed El-Arian was talking about that last mile in terms of inflation and interest rates, and so we'll see how that is going to play out here over the next couple of months. And then typically, you see IFA, emerging markets haven't done very well, as well as the NASDAQ down a little bit more. So pretty flat week for the market, but I think overall very constructive, just given the fact that we did see that tangible rise in interest rates, and that didn't necessarily necessitate a big sell-off in the stock market. Looking at the individual sectors for the week, so we did see energy pop. I do really like energy. I think some of those core oil stocks like ExxonMobil, CVX, Chevron, they pay some very nice dividends. Even if we do see, I think, a slowdown in the global economy, I don't think it's going to be dramatic. I don't think we're going to see a 2008 type of event. It's hard to forecast those type of things, but we just don't have a lot of those excesses really built up, at least within the private side of the economy. Public, clearly we know deficits are going up, and that's actually one of the chart of the week in this week's Market Minute, where we talk about the U.S. federal deficit and the trajectory that it's on. So, energy's I think a good play. You saw real estate down once again, more of those interest rate sensitive type of sectors. But overall for the year, communication services, technology, really leading the way, and that was, as we've seen, interest rates just kind of trend sideways, but really around AI. Those have really been the big leaders this week. But I think as things we get that eventual correction, who knows when we're going to get it. But when we do, I think that's going to tell a lot of what is going to be that next sector to kind of lead going forward. We know it's been tech for the last 4 or 5 years. It's great. We'll still continue to enjoy it. You want an allocation to that, but we also want to be looking forward into what could be that potential market leader going forward. Oil also trended a little bit higher so far this year. We started at $72 a barrel. We're now at $81 a barrel. So that's putting some support within those energy prices. And I think while I do see some global demand slowing down, we've seen that coming out of China and a lot of other economies, particularly Europe. US has really hung in there. But I think it's more about the supply side. The supply side is really constrained, particularly within OPEC, within what's going on with the Suez Canal. You're seeing a lot of transportation of oil having to be diverted all the way around the Cape of Good Hope. So that's going to necessitate potentially some slightly higher energy prices for the time being. Now, the U.S. on the other side is a huge exporter, but they only can get so much to those other economies, given the distance. So I think that could definitely lead to some supply continuing to be rather constrained within the oil market, and thus supporting markets, the energy prices here going forward, which also kind of ties into potentially making inflation, or that last mile of inflation, a little bit harder to crack. And I did talk about that U.S. Treasury. You can see here we were at 4.09 at the end of last week, and we jumped to 4.31. So that's something to really continue to watch here. Got above the 200-day moving average, and once again, I think if we get above 4.4, that could be a little bit of a danger zone, if you will, of those higher interest rates, and really the deficit increasing burden that those higher interest rates increase on the U.S. economy going forward. And rightly so. We also saw with that rise in interest rates, overall bonds were down as well. High yield still very much holding up. As I've talked about for now a couple of years now, I love high yield as a great economic indicator. Really has been just trending sideways since the middle of December. So I think that's telling us we've seen these nice equity increases here so far for this year, but the high yield bond market's saying we're not quite given the complete green light yet in terms of we're going to avoid any sort of economic slowdown towards the second half of this year. So that's really one of the key markets that we follow very closely at the investment committee here at Compak Asset Management. This is that U.S. federal deficit chart I was talking about. You can see this purple line shows where we are in 2024. So basically, there's only one line that was higher, and that was 2021. So clearly, you can see a huge shot up in the federal deficit in response to COVID in 2020, and then that additional spending really continued in 2021. But this year, it's an election year. You typically see some additional government spending during election years. The incumbent party likes to continue to promote economic growth headed into the November election. So this is one of the big reasons, and we're tracking this really closely, is why we think inflation might be a little bit harder to crack here than what the market's anticipating. Everyone's been, they're talking about 6 rate cuts, and then potentially now going down to 3 rate cuts. It could be even closer to 0 rate cuts, this year, if we do continue to see a lot of this spending, the federal deficit spending, continuing to kind of promote growth and employment, and thus kind of put a little bit of a bottom in terms of inflation. In fact, increasing inflation. That's what we've seen over the last couple of months. So one of these trends to really kind of follow, talk a lot about it in the Market Minute. So if you'd like to get that Market Minute, please just go to compak.com/media, put in your email address, and we'll have that delivered to your inbox. As we talked about the economic news for last week, CPI came in a little bit hotter. This week we do have housing starts, building permits, but the big one is, of course, the FOMC meeting on Wednesday. I'm expecting Jerome Powell to be a little bit more, I would say, not as dovish as he was in December. Particularly given the inflation data coming out over the last couple of months. I'm sure he'll still highlight that the trend is down, but I don't know if he wants to really stoke any sort of additional kind of easing of financial conditions, given how much we've seen an increase in the equity markets and overall activity continuing to look rather robust in the face of those higher interest rates that they've created here over the last couple of years. So we'll see. I don't think the Fed is as important as everyone anticipates. It is important, of course, but not as important as the media puts the attention on it. I think really following what they do around QE, what the federal government continues to do around deficit spending, which I don't think is going to change a lot, but really how the market continues to digest all of that inflation data that continues to come out over the next couple of months. I think that's really what's going to determine what type and size of volatility we're going to see throughout 2024. We will be having a tax webinar this week on Wednesday, March 20th at 6 p.m. Definitely tune into that. Sorry we had to delay it from last week. I'm still recovering from a little bit of a sickness with my young children, but looking forward to providing this kind of tax insights for all of our Market Wrap listeners this March 20th. At 6 p.m. So if you'd like to register for that webinar, there's still time. Just go to compak.com, upper right-hand corner. You can just click on the seminars and register for that event so you can get the webinar link. So you can hopefully get all those tax deductions and all of those in place for not only 2023, but also more importantly, preparing for your tax liabilities in 2024 and in the future. And that's what we do here at Compak with our financial planning and our tax planning services, is really looking into what is your tax liability in the future? How can we strategize today to look at your future and make efficient tax decisions today? And that tax planning is incredibly important. Just some of the topics that we'll talk about on Wednesday is ways to reduce your taxable income, tax smart investing, tax strategies for business owners, donating appreciated assets and charitable giving through qualified contribution deductions, as well as Roth conversions. So those are just a couple of the topics that we will touch upon on Wednesday. But if you'd like to register for that webinar, please just go to compak.com/webinars to register. Well, no technical analysis for us today. I'll leave that to the man himself when he gets back next week. So I appreciate the opportunity to present this edition of the Compak Market Wrap YouTube channel. If you'd like to learn more, please visit us at compak.com/media, subscribe to our Compak Communications, or of course tune in to our weekly podcast where we dive into all of these topics, what's going on in the market today in greater detail. Thank you for watching.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.